Hello everyone, my name is Elizaveta Belugina. I'm the leading analyst at FBS, and today we'll discuss the outlook of the Forex market for the next several days. We'll outline the technical and the fundamental picture for Forex measures, and then I'll share my trade ideas. And if you have any questions, don't hesitate to ask me in the chat or in comments to this video. So let's start. You can now see my presentation and a couple of words about this week. It is, I think, the last week of calm ahead of a very volatile events which are going to happen later in September. I mean the meetings of the US Federal Reserve, the Bank of Japan, the International Energy Forum in Algeria, which will be very important for the oil market. So, in my opinion, we'll have a very volatile and very intense second half of the month. So now we have time to get ready, to get prepared for these events. Our agenda for today is the following. Firstly, we'll talk about how the market is positioned. Then we'll look into the economic calendar in order to understand what important events lie ahead and how to prepare for them. Then we'll go to the MT4 to see the price charts of the major currencies and fill in you on the tips and on the summary and trade ideas for these pairs. The dynamics of the main currency pair during the last week was very different. The dynamics of the US dollar, we saw that the greenback managed to strengthen against British pound just a bit, and against Australian dollar. However, it fell versus the euro dollar increased. It made a big decline against Japanese yen and Swiss franc, and also gold strengthened a bit versus the greenback. If we look now at the US dollar index chart, we can see that the index made a big, rather big increase on Friday, but then in the first days of the week it is trading sideways around 95-point mark. We know that on Friday American stock market fell significantly on suggestions of the Federal Reserve Board member Rosengren that interest rates may rise sooner than expected. However, these hawkish comments weren't followed by another hawkish comments from the Federal Reserve member Bayard on Monday. She said that it is kind of too early to raise interest rates, that the Federal Reserve shouldn't be in a hurry. And we see a very interesting situation right now. Some members of the Fed clearly want a September meeting to be live, for the market to think that the regulator can really raise interest rates in September, but other members of the Federal Reserve are not so eager. We can see that there is a split of opinions in the FOMC, the body which makes decisions on the federal funds rate. And as a result, this lack of agreement in the Federal Reserve really decreases the probability of a rate hike in America this month. As a result, the upsides for the greenback should be limited. There will be probably some upside as other currencies don't offer a very good alternative to the American currency. But still, the Federal Reserve is putting off a rate hike, and as a result, American currency is lacking a key driver. And I believe that when this day comes, September 21st, the meeting of the Federal Reserve, when we'll see negative pressure on the greenback, for which will be maintained for some trading weeks ahead. If we look at how the market is positioned to the US dollar, we can see that the aggregate USD bullish position increased last week. This is the data from CFTC, Commodity Futures Trading Commission. The data are released every Friday for the week which ends at the preceding Tuesday. So the current data were released on September 9th, and they were for the week which ended on September 6th. So we see there is a time lag in this data, and we can't entirely rely on these figures. However, they are still important because they show us the big fundamental shifts in the positions of large speculators. There was a bullish reaction for the US dollar, an increase in net long positions. And this reflected some high expectations of the Federal Reserve's rate hike. Now I think that this increase doesn't represent any sustainable trend, bullish trend for the US dollar. It is just some adjustment of positions, and traders, even some large speculators, probably want a risk to take any definite side ahead of the Federal Reserve's meeting and ahead of the Bank of Japan's meeting, which will happen next week. The market will decide to wait and see, because even though traders can expect something, can make forecasts of how the central banks will behave, what will be their decisions, still the uncertainty remains, and the uncertainty will diminish only when the actual meetings of the central bank takes place. So no trend for the US dollar, just some increase in bullish positions during the past week. Let's have a look at other currency pairs, other major currencies. We can see that the bearish position for the euro increased. Still, the data will be for the period before the European Central Bank's meeting on Thursday, when the regulator kind of disappointed investors and didn't increase monetary policy stimulus, and failed to tell the market when such measures will take place in future. So traders were disappointed. Euro rose by the end of last week, but still we see that there were some short positions, and the net position is bearish. British pounds bearish position didn't increase much, so it remains practically unchanged. And the bullish position for Japanese yen, probably an interesting fact, it decreased by 1,000 contracts. So these are the trends at the Forex market, the base trends of positions in large speculators. And just a quick look at the COT indexes, which allow us to study the relative readings of these positions and contracts, bullish and bearish. Here we can see that the green line for the US dollar index, which reflects the position of large speculators, is in the bullish territory. So is the red line, which reflects position of smaller speculators, and their commercial companies are hedging against the decline of the US dollar. So the picture is rather bullish, but we are still not at the maximum levels of these indexes, which shows us that we are closer to the middle sideways range for the market's contracts, the market's position on the US dollar. So the market isn't totally bullish. It is just some small bullish developments, but still we haven't reached important levels, important high readings. And it is interesting to look at this COT indexes for British pound US dollar currency pair. Here we have an improvement in the market's position. We see the red line, which shows the positions of smaller speculators is moving to the bullish territory. However, we see that the large speculators don't follow this trend. They still remain rather bearish on the British pound. It means that the attempt of GBPUSD to move higher isn't supported by the actions of the large players, only by the smaller players, and this of course declines and reduces the strength of the pair's move to the upside, and allows us to think that still any bullish attempts lack strength for the British pound. And here I also have a chart for dollar yen. Here the layout is the index of large speculators is at the bullish territory, but it is declining. And all in all, the lines are in more or less trendless position. We see that the open interest doesn't increase, which means that here we also have a lack of trend dynamics. And dollar yen is expected to remain near the current levels, at least ahead of the important events, the meetings of the Federal Reserve and the Bank of Japan. And interesting to look at the dynamics of commodities. We see that crude oil dynamics is very important for Forex market, for commodity currencies, firstly. And here we can say that the open interest for crude is rising, but the picture is getting more bearish. We can see that only small speculators are turning bullish, while large speculators are turning bearish on oil, and this is something to think about if we are trading oil. So what important events await us in the coming days? We will look at the UK labor market data on Wednesday, US crude oil inventories, and New Zealand GDP. On Thursday, there will be Australian labor market data release, the meeting of Swiss National Bank, the meeting of the Bank of England, US big block of statistics, which includes retail sales, producer prices, and other very important indexes. And on Friday, Canada will release manufacturing sales, US will publish inflation and preliminary consumer sentiment figures. So there are important events in the coming 3 days, which remain of the current week. The event I'd like to focus on is the meeting of the Bank of England. The regulator is expected to keep the interest rate unchanged, taking a wait-and-see approach after it slashed growth forecasts and increased monetary stimulus in August. Traders will pay great attention to the meeting minutes to see how the central bank evaluates the UK economy after Brexit vote, given the fact that the nation's economic figures tend to be better than expected. If we take the recent data releases, which were published in the UK, we can see that the situation isn't actually as bad as some analysts thought it would be after Brexit. So Britain released very inspiring construction, manufacturing, and non-manufacturing PMIs. Actually, services PMI showed the biggest gain in 2 decades. On the other hand, manufacturing production, a key indicator, suffered in July from bigger than expected decline of 0.9%. Of course, we can clearly see that the economic picture for the UK isn't very rosy, but it isn't very dismal either. And it is very interesting to see how the central bank evaluates the UK economy after Brexit vote. We know that last month the Bank of England signaled a possibility of further monetary easing this year. So it will be interesting to know whether they changed their mind or not. For now, most economists expect British Central Bank to lower the benchmark rate once again this year. And we can see these expectations here at some price charts by Bloomberg. Here we can see that investors are almost sure that the interest rate will remain unchanged tomorrow, on Thursday, and here we can see that still many analysts expect that later this year the Bank of England will reduce its benchmark rate. Also, if we speak about British pound, it's interesting to know that the Chancellor of Exchequer, Philip Hammond, last week downplayed the likelihood of a big fiscal boost for the economy in his November 23rd autumn statement. And this can mean that the Bank of England alone will have to help British economy to recover and to gain strength. And it might mean that the Bank of England will have to increase monetary stimulus in the future. So these expectations, I think that the Bank of England will have to do something more, somehow ease its policy, will limit the ability of the British pound to strengthen in the medium term. And any increase in pound will be temporary. Also, among important events will be the block of the US statistics on Thursday and US inflation figures, which will be due on Friday. American inflation is one of the important reasons the Federal Reserve is so reluctant to raise interest rates. We know that this inflation is very low and it undershoots the Federal Reserve's target level. So some improvement in this indicator is needed for the Federal Reserve to move towards the interest rate hike and for the market to expect that such step is possible in September. This is the fundamental basic picture. We will talk about fundamentals a bit more when we'll switch to the currency charts and discuss fundamental and technical picture together. We start with the euro dollar, but as usually we start with the weekly chart of this pair. So what is the background for the euro? It is something we haven't discussed yet. As I have already mentioned, the single currency strengthened last week. Traders were disappointed that the European Central Bank didn't ease monetary policy. On the one hand, the ECB signaled that it is ready to increase stimulus in future, but gave no hints on exactly what and when it plans to do. As the possibility of the US Federal Reserve lowering rates in September remains low, monetary policy divergence between the ECB and the Fed has weakened, and so the downtrend pressure on the euro declined. At the same time, the amount of the market's net short positions on the euro wasn't high, so the squeeze of these positions won't be able to produce a sustainable growth of the European currency. And we saw it today that the Federal Reserve's members this week weren't hawkish, and this weekend the US dollar allowed euro to gain. However, we see that on the weekly chart, euro dollar failed to close above 100-week moving average. We can see that this line is providing resistance for the pair since May. Actually, there were several attempts to get to this line and several attempts to get higher in the recent periods. The distance between 100-week moving average and 50-week moving average, which is located at 1.11, and 100-week moving average is around 1.1250. The distance between these lines is getting narrow, so the time when the euro dollar will have to choose where it will trade, above this green line or below this brown line. This time is approaching, but still in the coming week, as we have some important statistics, but probably these data releases won't be big market movers for the euro dollar. Then our base scenario is that it will be hard for the euro to get past this line. So the range is settled between this 1.1250 and 1.11 marks. This is the majority of the range for the coming days. Then we switch to their daily chart. Here you can see that I have an indicator, pivot points multi-time frame. I spoke about this indicator in the webinar which took place last week. But for those who haven't seen it, I like to point out that we have a line, the central line, the pivot line is painted in light blue. And if the pair is trading above this line, then the outlook is generally bullish. Below this line, the outlook is bearish. This indicator shows us a bit another range for the euro dollar. It is somewhere between 1.1140. Here we also find the minimums of the beginning of September, late August, and the technical lines, moving averages, 50-day moving average and 200-day moving average. They are closely together in this area, which means that this support is actually strong. Here on the upside, we have the first weekly resistance line at 1.1326. Here is also the maximum of last week, where the pair failed to break higher. So this allows us to expect consolidation of the euro dollar between these levels. Probably we'll even get something like the triangle formation between these levels. And I believe that these levels allow us the opportunity to enter positions for the euro dollar. So selling will be attractive in the area of 1.13, and buying will be possible in the area of 1.1160, 1.1150. As I say, the main scenario is that the euro dollar will remain consolidative. We saw the range which was determined for the pair on the weekly chart, and the range which is on the daily chart. In places these ranges have common levels, so these are levels around 1.1140, 1.1250. I believe the main trading will take place for the euro dollar in the coming days. Also, pay attention to the fact that there is support of 100-day moving average at 1.1209. Here it is prevent the decline of the single currency for 5 days already. And also notice that the daily moving averages remain horizontal at this chart, just as they remained last week and the week before that. And the dynamics of the euro dollar during the last weeks is more or less sideways, and even during the last months on the daily chart it is clearly seen that the euro dollar has probably found its fair value, the value of balance somewhere around 1.11, 1.13, and the market is unable to move far away from this range. The policy of the European Central Bank doesn't pull the euro dollar to the downside much, while neither does the policy of the Federal Reserve. On the contrary, there are no reasons for big declines in the euro dollar, but the policy of the European Central Bank is still much more loose than the policy of the Federal Reserve, so there are no reasons for significant growth from the current levels. This is the current layout for the euro dollar. It is kind of disappointing maybe for some traders who want to see a beautiful trend move, some new highs, new record levels, something interesting here, much of dynamics, but I'm afraid that we are not going to see this, and probably even if the Federal Reserve holds rate then and doesn't increase rates in September, the expectations of such step are low, and as a result, the market won't be very disappointed that the Federal Reserve will leave policy unchanged in September, and the potential of the euro dollar to strengthen as it probably breaks this consolidative pattern on the upside will be limited, and will probably be selling euro around 1.15. Next week. I'm just getting ahead of the events a bit, but just sharing with you my view on how the dynamics of the euro dollar will develop in the coming weeks. For now, we trade in this range, and let's have a look at the 4-hour chart. Here, the moving averages get close together, which means the lack of volatility, the lack of direction for the pair. Support levels are practically the same here. Here we also see that the same levels, which are on the senior time frames, are also important for the pair and play a great role. If there is a kind of break to the downside in the euro, then the target of which will be formed by the break of this short-term small uptrend will be around 1.11, and here the pair will once again find the solid support and move towards 1.1250. So it is all rather simple. We move to our next pair, British pound US dollar. We spoke about the fundamental picture for the British pound, the expectations that the UK central bank will leave policy unchanged, but of course there are still many things the Bank of England can say us, and it is rather difficult to predict which way will they move the exchange rate. Still, we can have a look at the technical chart in order to see how the market is preparing for the meeting of Bank of England, for the upcoming releases of the United States, and make our judgment based on these technical signals. Firstly, we look at the weekly chart. We can see that last week there was a bearish candle formed after the bullish candle. This bearish candle looks like a shooting star. It has a small red body, a small bearish body, and rather long upper shadow in comparison with the candle's body. And this candle shows that the buyers were unable to push the prices above resistance at 1.34, 1.35. This is a very solid resistance level for the pair. Here we can find the former support and now resistance line, which used to be in place since the start of 2015. So these are the levels, the obstacles for the bulls, which will be difficult to overcome. Taking into account the bearish candle, the odds are that we'll see bigger decline of the British currency in the coming week. On the contrary, on the downside, the levels around 1.2840 represent a solid support for the British currency. Several attempts to break this level were unsuccessful, and here lie the multi-year minimums. So any targets for the British pound should be limited by this area. Let's have a look then at the daily chart. At the daily chart, we can see that, the picture is pretty much the same. We can see that there is a support line just near the place where the prices are now. It is located around 1.3220, and the next support is at 1.3150. For our chart shows us the picture in greater detail. We can see that during the last 4 weeks there was an uptrend in British pound US dollar currency pair. However, then we got something like head and shoulders pattern. We can try to draw the neckline here, and after that British pound fell to the levels below 1.33 mark, and now I think that the pressure on this support line around 1.3230, 100 period moving average and the 4-hour chart will intensify. Today, Britain released lower than expected inflation figures, and these figures suggest that the Bank of England will be able to keep increasing monetary stimulus, which is a negative event for the British pound. Of course, we already spoke about positive developments in British economy. Some analysts think that the Bank of England has already done too much in August. However, still there are concerns about the British pound. They remain, and we'll be looking at this important point of the price chart. If this support line breaks, then we'll sell the pair targeting levels around 1.3190, 1.3111. These are the next weekly pivot levels. Probably will get even lower to this support around 1.3060. Some way to play down the magnitude of this trade channel. So we see how wide it is, and then see where the targets may lie. And targets may actually lie at close to August minimums if this range, if this channel is breached. If on the other hand the pound finds a support at this line, then the bulls will make another attempt to get higher, and in this case initial resistance will lie around this pivot level in the area of 1.3317, and the next potential target will be at 1.3395. But I think that this formation formed last week looks too much like a top for the pound to show us any big increase beyond this 1.34 level. We remember that here between 1.34 and 1.35 is that band of resistance we saw on the weekly chart. So our baseline scenario is negative for the British pound, and in the next session we'll see whether we'll sell the currency on the break of this support line, or we'll sell it higher on some another attempt to recover. Still, I think that this attempt of the British pound to strengthen, which we saw in the last few weeks, will be rather difficult to continue. Of course, long positions, small long positions are also possible in the coming days if we have a rebound here, but they will be more difficult, and no significant moves here will be also seen ahead of the Federal Reserve's meeting, which is a limiting factor for all major currencies, unless the Bank of England does really something unexpected and really surprises the market. All in all, the base scenario is that the meeting will be a non-event, and that the policymakers won't make any big comments about the British economic picture, which will be able to move the market. All in all, British policymakers are interested in weaker pound because it helps the economy to improve. And the fact that British inflation data released today didn't show us bigger gains. On the contrary, they came weaker than expected. It means that this lower pound isn't for now creating too strong inflation in the UK, and that the British pound may be kept at the current levels or even lower. For now, inflation is in control, and no need to worry about the fact that the British pound is too low and creating too strong growth in consumer prices. So British pound could stay lower and continue helping British economy. Dollar yen. Here, the fundamental picture comes back to the United States, as we don't have any interesting releases from Japan. What can they say about this pair? On the weekly chart, we can see that the pair did once again test 2016 resistance line, but the overall dynamics was negative. The weekly candle is bearish, but some factor which is a bit inspiring is that this candle has a rather long lower shadow. It means that the bulls did manage to improve the situation a bit by the end of the week and close not at the weekly minimum levels but higher. Still, the pair is expected to remain under pressure and remain in some narrow ranges. Here we will have next week the policy meetings of two central banks. So the fundamental background is determined by the market's expectations for the actions of each of the central bank. And from the part of the Federal Reserve, I think that the US currency and dollar yen has already got as much support, as much bullishness as it could have managed. And now traders will look at the Bank of Japan as the main factor, the main driver for the dollar yen. For now, traders don't expect much from the regulator because the monetary policy of the Bank of Japan is already extremely loose. The recent commands of Japanese monetary authorities didn't offer much hints that the regulator plans to act in September. There are some rumors that negative interest rates are already considered in Japan too dangerous for the banking sector, as these negative rates affect the bank's profits. So the Bank of Japan won't cut the interest rate anymore, but it may increase stimulus a bit in order to promote inflation. But we remember that in January, after the Bank of Japan did ease policy, Japanese yen strengthened. So we can remember that the market doesn't actually put much faith in the ability of Japanese central bank to reach its inflation target and to change this overall trend of Japanese yen. Still, support at 100 yen mark looks pretty solid, and it will remain so until the next week. Of course, dollar yen is the currency pair which is the most sensitive towards the Federal Reserve's rate hike, but in the coming days, the volatility shouldn't be very great. Here we have the daily chart, which should give us a bit more insight on how the pair is trading and which levels to watch. We can see that here once again I used these indicators, pivot points, multi-time frame, and for analyzing Forex market, for doing the outlook for several days, I use the weekly settings of these indicators. So these red lines are weekly resistance levels, and these blue lines are weekly support levels. The pivot level is located at 102.67. The pair is currently trading below this level, and it means that it is trading on the bearish territory. We see that to start any bullish positions in dollar yen right now, we need to wait until The pair closes above this level of 102.67. Here also lies the resistance line drawn through September highs, and also here we have 50-day moving average. So this resistance is pretty important for the coming sessions, and if the pair is unable to overcome this level, then our attention will turn to the first weekly pivot support mark, which is located at 101.20. Here we have the minimum of September 7th, and also this indicator line. So I recommend to place at least a part of take profit order here. The decline below this level, the close below this level, will activate this double top pattern and send the pair towards the recent lows in the area of 199.75. This will be the targets on the downside, and as I said, this support looks pretty solid, so I wouldn't risk setting lower take profit levels. For now, I think this is all the bears may hope to get at this price chart. So if we look at dollar yen, here trading is kind of devoid of immediate fundamental factors. There are expectations for the events which will happen later next week, and here we have technical levels rather distinct, which can be used in trading and in placing entry and exit Forex levels. As for another currency pair, Australian dollar, US dollar, here the picture is pretty interesting as well. We saw that last week Australian dollar made an attempt to get higher, but once again it faced strong resistance on its attempt to approach 0.77, and they got this extremely bearish weekly candle which closed below 100 week moving average. So it shows us that there are serious sellers of Australian dollar on approaches to 0.77. So the pair looks, in my point of view, unable to show us any significant growth. We are also having this multi-year resistance line here, and bullish positions doesn't look attractive in no way here, no bullish positions. So we are in bearish mood for this pair, but which targets should we choose? Where will a pair go? How deep will be the decline? Probably we'll get the view here. Let's draw a line which connects the minimums of this year 2016 support line. We can see that this line is located just below 0.74. Here we also have nearby the bottom of the daily Shimon cloud, and this is our target, our bearish target for Australian dollar. I think that at current levels, at levels around 0.76 and 0.77, Australian dollar was overvalued, and it's closer to fair value around 0.74. We can see that the pair is drawn to this line. It should once again touch this line for this movement to look complete, and I think that it won't be able to break lower on its first attempt to get below this point. So here we should probably place our take profit orders. For now, the pair had support around 0.75, 0.7485. Here we have 100-day moving average, which is supported the pair for the second time already and even third time. There was a bullish candle formed on the chart on Monday. The candle was formed as US dollar was weakened by some negative comments of the Federal Reserve, which deflated the expectations of the US rate hike. But the ability of the Australian dollar to strengthen further doesn't look very convincing. We can see that there is the negative bearish candle following this hammer-like candle which was formed on Monday. And we are watching for the levels around 0.7485 to enter short positions, targeting 0.74. I think this will be a very nice movement of the pair. Also, keep an eye on Australian data releases on Thursday. Labor market data will be published. It will be important for this pair as well as US economic data. All in all, the market's risk sentiment, which was very negative last week, has somehow improved. We saw that Chinese industrial production and retail sales data came above expectations, but the price of commodities is still under pressure. The price of oil is under pressure and is expected to remain so in the coming trading days. So Australian dollar doesn't really have its inner drivers to the upside, and it will be drawn to the mentioned support levels. If we see that this support at 0.7485 holds and there is another recovery of the pair, once again, we don't think that this resistance line in the area of 0.77 will be breached. We'll once again face resistance here, and it will be a good level to sell Australian currency without, I think, any hesitation. Traders will act here. The pair is supported by the fact that the Federal Reserve isn't expected to cut interest rates, and all in all, I think that this pattern, this triangle pattern, will remain intact in the coming week and maybe even later. So these are the reference levels to trade Australian dollar. This is all for today. Let's now have a conclusion of what we spoke about today, a sum up of the Forex market outlook for the major pairs. So traders await the meeting of the US Federal Reserve, which will happen on September 21st. And US dollar is affected by comments of the Federal Reserve's members. There were positive comments for the American currency on Friday. There were negative comments for the greenback on Monday. Generally, the market now isn't expected the Fed to raise rates. The expectations are very low. So we see sideways dynamics of the greenback. There will be important data releases ahead on Thursday, a big block of American statistics, including retail sales and inflation data from America on Friday, but they probably won't change the baseline scenario expectations that no move will come from the Federal Reserve. Still, the market is in the wait-and-see mode ahead of the meeting, and the speculators won't make large positions, they won't take sides, and they won't move to the market in this or that direction. As a result, we are moderately bearish on British dollar, British pound, US dollar currency pair. We target levels around 1.3180, 1.31. As for the euro dollar, it is expected to remain in the range between 1.1140, 1.1325, and will trade according to these levels. For dollar yen, the reference levels to trade are buying on the break above 102.67 with targets around 103.50, and selling on the inability to break 102.60 with target at 101.20. For Australian dollar, the pair is vulnerable for decline below 0.7485, and the target will be at 0.74. The lower levels of Australian dollar are not expected ahead of the Fed's meeting. This is it for today. I thank you for your attention, and stay in touch with Forex market. If you have any questions, they are welcome in comments to this video. Thank you.